Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Monday, April 14th, 2025. Today's episode begins with our headline, Markets Up. VIX crude oil aren't convinced. The whipsaw continues. Oh no, tariffs! Just kidding. Oh no, tariffs! Just kidding. Oh no, tariffs! Just kidding. The VIX did go down today. This prices options contracts and is an expression of volatility expected in the market. Although dropping lower, this is still at 30. This is still considered to be high. On Friday, it looks more likely to have the potential to pop up to the upside further, and today there's a little less of that potential, but it is still elevated. Yesterday's VIX futures term structure in gray here, the whole curve was a lot more elevated, and so it's actually the entire curve that dropped, and so this market is expecting sort of like volatility currently going towards more settling at the moment, yet still elevated at 30, waiting for our dear president to take out his tariff bat again. The other market not convinced that this is all over is crude oil after plummeting straight through a psychological level of $65 a barrel and then consolidating down here. This is very clearly at this point as it stands a bear flag. This market is saying, well, we are very much not willing to be buying crude oil per barrel at higher prices than where we are currently fighting, around $61 a barrel, a price not seen this low for 3 or 4 years now. And pretty much every other chart you look at is in whipsaw mode. One day we're way up, one day we're way down. The whipsaw continues, it seems. Next up, before we get into the rest of the charts, I do have some interesting things to be talking about today. But before that, we'll mention our community topics. I love hearing what you guys are doing. It's a great place to inform the community, the Robschild community we have here, of anything that you're doing, if you're buying anything or selling anything. Today for me, Robschild sits on his hands. I'm comfortable with my positioning at the moment, and I didn't do anything today. Coming up, what else is there to talk about other than potential more tariff updates and how Mr. Market feels about tariffs day to day? If you didn't catch the community post I put up on the YouTube channel, I used ChatGPT to help me come up with this cartoon. This is an original. It expresses how I see the stock market right now. Basically, it's Trump carrying a bat labeled tariffs, and every time the stock market feels bad, he takes out his chicken noodle soup and says, oh, we're going to pause it a little, but don't worry, it's not going to be that bad. And then it goes up again and he takes out his tariff bat. It's a bad stock market. It's a bad stock market. Oh, it's not that bad. It's okay. It's a bad stock market. Bad stock market. It's okay. It's okay. So coming up, I think we all can expect continuous tariff updates. The show continues. Before that, thanks for watching, subscribing, commenting, and supporting. I've been getting amazing views, subscriptions, comments, and support. It's all wonderful. So thank you. I still don't feel like doing a new macro update until things at least settle down. I've added things over the past few weeks. Just recently, consumer sentiment index being at basically historically low levels. This is very concerning. I always say at every show, watch macro update to 1125 to hear me explain most of the rest of this. And watch portfolio update to 1125 to hear me explain most of my portfolio. I also added, because on Friday I bought some calls on TLT, specifically July 18th strike price 95, and GDX, shorting gold now. I do want to talk about gold. Before we get to gold, I want to start off our chart rating with taking a look at the S&P 500. Today we moved up by 0.79%, a pretty small move considering how high the VIX is still. with less tariffs involved with microchips and computers potentially over the weekend and then actually turning into a pause. A lot of people, including myself, were thinking that Mr. Market would get a little bit more of a bid here. If this is all the steam that the bulls have right now, all I can say is watch out below. I think the bulls need a lot more good news moving forward. I mean, we do have earnings season starting. I think Netflix is the big main one that we have this week. I really don't see anything pushing the market higher here, but that's just the crystal ball rating. Robschild, why did you short gold? What's wrong with you? Gold is just so shiny and so high in price. It's expensive. It's wonderful. Why are you short gold? Well, gold went down today, actually, almost 1%. It went above this previous channel that we were playing around in. It's not very typical that you get such an exuberant, huge move to the upside without at least a pullback. I'm looking for gold to pull back to 3,100. I hear other people saying that it's actually from this kind of move very likely to get all the way back down to the 2,900 level. Chartists better than me are expecting us to get there sooner than later. I don't just short gold because of chart patterns. I also have macro reasons for this, and I've talked about these before, but I'll review them again right now. The real estate to gold ratio. It has never costed less gold for a house than it costs right now. But Robschild, I thought homes were really expensive. Yeah, they are. So if home prices are way too expensive and gold is even like more historically expensive relatively speaking to that, it just tells me that gold is, I see a lot of downside potentially on gold. But gold, it can keep running higher. It is the safe haven asset that has withstood the tests of time, and if people are worried about inflation, if people are worried about anything, they get into gold. My only thing is it's way more expensive than it has been in a long time, especially just compared to the price of a home. Also to copper. We use copper for stuff. So how much gold should copper cost? Well, copper relative to gold is really cheap. Nobody wants copper. This just screams as well that, economic slowdown coming. But any which way you look at it, any kind of reversion, in other words, return to normal valuations, would make gold drop at least, I don't know, 5 or 10% from here would make a little bit of sense to me. And if the reason for buying gold is to fight deflation, well, something doesn't really make sense in the tips market and gold price. These are supposed to move in sync with each other. When people are worried about inflation, the tips market goes up along with gold. And so for the tips market to be going down with gold going up, this is a pretty major divergence. The bond market, much bigger than the gold market, by the way, is saying, no, we're not so worried about inflation. Everything is saying that gold will cool off here. Oh, there's one more piece of the charts for gold. So this has the RSI down here of gold. Someone else brought this up on a show. And this is not something to ignore. When you have the relative strength showing a lower high, as it's very, very clear here, and gold is showing a very clear higher high, this is a major divergence. It's screaming that gold is about to really plummet here, actually, from this level. So that 2,900 level is, in my book, very likely for every reason. But that's just me and my crystal ball. Part of what allowed U.S. stocks to go up a little today was a little cooling off of the 10-year Treasury note yield. If you remember, I'm sure you do, if you're watching this show, at the end of last week, it almost seemed like the 10-year Treasury note yield was getting out of control to the upside. It seems like we're back in control. It's important to remember the power of the 10-year Treasury note yield. If this goes up unhindered, it means that everyone that owes debt, companies, all the NVIDIA, every company that operates on debt, more of the profits that they make have to pay the interest payments, which are going to get a lot higher at a faster rate than the growth of the 10-year Treasury note yield. That's why we use this as such an important proxy for understanding business lending and the valuation of businesses. So this looks like we are showing a little bit of control finally in this market, which is, that's a good thing. That's what the powers that be want to have happen. That's what started this whole like pausing thing in the first place. This looked like it was getting out of control. Hit the pause button. Now it's in more control here. So now we can take his tariff bat out again. I digress. Junk bonds still in whipsaw mode, not super strong. I mean, granted, also not super weak as of today, as of right now. Again, just another market waiting for the next tariff bat. The other way of looking at this is seeing credit spreads for junk bonds. How much more do small companies have to pay for their debt on top of the treasury rate? That's been spiking lately, and today, as of this morning, it's been cooling off a little. But I just want to remind everybody, during major upheavals of credit spreads where it's just going to the moon, you get spikes and you get dips, and we haven't even seen anywhere near the kind of spikes that we saw in the COVID dip, or scrolling out further, the great financial crisis. I mean, look at what happened from March of 2008 until May of 2008. For 3 months, credit spreads were getting tighter again, not falling apart anymore, before the humongous credit spread widening up to 20 by November of 2008. I am seeing this current spike that we are in as potentially not over. Another chart that's been catching my eye is just the advanced decline line, and it's like a little bit of tea leaves, but seeing a higher highs and higher lows in this, along with this sort of consolidation, like not knowing where to go, it tells me that Mr. Market's at least smartening up a little bit here, getting out of the mega cap, like super overvalued, multi-trillion-dollar companies here, and going into stocks that they see as more safe. That's kind of what I see happening from looking at the advanced decline line. And certainly, I just had someone who doesn't know I'm a finance person talk to me about how their brokerage is basically recommending people to get out of large cap and into more mid caps. Again, stuff that doesn't have such excessive speculative price in an enormous amount. Like, these are multi-trillion-dollar companies, so at least, and I see that as healthy. I see that as like Mr. Market getting a little bit more healthy here. When markets go up or down, I always like to check out, what are people buying? What did people buy today? What went up the most? So interesting one-day performance. We have real estate, utilities, and consumer defensive getting bids here. And while energy has been outperforming the market for quite a while, energy being in the bottom part of this, not only that, we look at the 1 week performance, technology still in the lead. That's still a little worrisome to me. If we are headed into a recession, it just means more people are going to get hurt more badly. But the other thing with the 1 week performance is energy being the lowest performer. If you remember this chart that I've brought up before, during the recession is when energy gets the worst performance. Of course, these things are a bit fractal when you're especially looking at day performance, week performance, but it's not something to completely ignore when we scroll down and look further out to the 1 month performance. Energy dead last. 3 month performance, third to last. So overall, me and my crystal ball are seeing people getting more towards more defensive plays. because the orange man with a bat, who knows what he's going to do next. I am still holding SOXS. I bought that on last Wednesday when we got to the neckline after we broke it and tested it, and we basically opened right on it today before rejecting to the downside. So the way that I look at it, the bears are still in control here. This becomes even more evident when we take a look at one of the largest holdings of that fund, Nvidia. Over the weekend had news that it's going to be spending $500 billion on producing more semiconductors. Okay, great. How does that make there be more profits, though? That's what I'm wondering. And the market agreed with me because the Nvidia actually closed negative for today while the stock market was up. I'm thinking I might not be the only one out there wondering when we will get to the point where we're overproducing these things and the profits, aren't looking like they're going to quadruple every year for the next 50 years. But what do I know? I'm just a guy with a crystal ball. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching and see you next time. Robschild.